Hello, you are watching the FinTech Magazine Show, brought to you by FinTech Magazine, InsurTech Magazine, and BizClik. My name is Scott Birch, and we bring you all the latest news, analysis, and opinions from the wide worlds of FinTech and InsurTech every 2 weeks, right here on LinkedIn Live. And also, this is available on YouTube and across our other numerous digital platforms too. Joining me today, as ever, is FinTech and InsurTech editors Joanna England and Alex Clere. Joe and Alex, are you there, and how are you today?
Hi, yeah, all good today, thanks, Scott.
Yeah, very good, thank you.
Excellent. I'm glad to see you got the memo about wearing black today as well. So we're looking suitably somber for this late September show. So just to remind you all, wherever you're watching in the world, do come and say hello by posting in the comments section underneath the show. And there's also still time to vote in our regular LinkedIn poll, I believe. So Joe, what's the question we asked our audience this week?
The question we asked our audience this week was, are real estate investments in the metaverse a good idea? Options are A, yes, it's an opportunity. B, it's still risky. And C, no, it's foolish.
Right, okay. I always like to see 3 options. I've been reading quite a lot about the metaverse this week, actually, so it'd be very interesting to see where our very sensible readers, our very sensible audience, how they feel about this as well. But we'll come back to that. We'll bring you the results of the poll and some comment on that towards the end of the show. But first, let's start with our now traditional look at the latest news. Okay, Joe, why don't you kick things off with a bit of fintech action?
Yep. Well, the story I wanted to focus on today is headlined, "Will Ethereum merge boost crypto back to pre-winter levels?" And it looks at the latest move within Ethereum, which changes it from a proof of work blockchain to a proof of stake blockchain. Now, what exactly does this mean? Well, proof of work, which was what Ethereum was on, is basically provides a competition between miners to solve the cryptographic algorithms or equations that validate the transactions and then go on to earn blockchain rewards. And on the other hand, proof of stake implements randomly chosen validators to make sure the transaction is reliable and then rewards with crypto. So it is actually very, very different, and it's been an extremely complicated process. A lot of people on the team who are managing this shift between blockchains have basically been studying it for years and weren't sure that they were ever going to be able to do it, because they've likened it to something as complicated as swapping out the engine of a car while it's still running. That's how tricky the maneuver has been. So for a long time, nobody was sure if it would work, but now it's happened. And the result is that Ethereum is now 99.9% more energy efficient than it was prior to the move. And if we're to sort of quantify that in terms of energy saving and net zero, it's comparative to basically if Finland were to turn off its power grid. That's how much energy is now being saved now that Ethereum has been swapped over to this new form of blockchain. So on the face of it, looks very positive, looks like it's going to be very successful. It is a massive change within crypto. It could mean a lot of other digital currencies following suit, or a lot of other digital currencies suffering badly as a result. But there's no doubt that it's a game changer. So, but there are some potential downsides, and because now that Ethereum's proof of stake, it sort of transforms its position to more of a less of a decentralized currency, and that could make it come under further heavy scrutiny from the Security and Exchanges Commission. But I'm actually going to I've got an interview that I did yesterday with an expert in this in this whole move. I spoke to Dmitry Ivanov, who is CMO of CoinsPaid, and we talked about how the merge could potentially destabilize Ethereum due to the SEC influences and what the fallouts might be. So if we can get that video up now, that would be great.
Crypto has always been criticized for the fact that the mining is so energy intensive, and it does create a lot of emissions. So would it also be likely to suggest that other digital currencies might want to follow suit on a similar vein, because investors will be more interested in something that is more ESG compliant?
If you are talking about compliance itself, right now it's a good question. What is Ethereum? Where it was a proof of work protocol, it was decentralized, and no any questions has been applied to Ethereum on behalf of SEC, American SEC, I mean. But once it becomes proof of stake protocol, SEC already trying to make a pressure on Ethereum. Of course, it might be more compliant, of course, but what will happen the first? Ethereum becomes more compliant, or SEC punish them as a security asset. If the second happens the first, so it's a good question if Ethereum will stay stable and liquid asset, because everybody knows then if SEC punish anyone in crypto sphere, it's always like a fine of dozens of $millions. And in case of Ethereum, it might be even billions, I would say. So here we should decide. It's like a tricky question.
Okay, it is indeed a tricky question, as Dimitri said there. I mean, yeah, the figures certainly sound impressive, right? I mean, did you say like 99.9% more efficient or whatever, or using less?
Yes. Yeah, because essentially
look,
it cuts out the mining process and uses sort of algorithms to sort of fix the rate. So yeah, the savings in energy are just absolutely huge. Which I do think it'll make Ethereum much more attractive in terms of an investment.
Yeah, I mean, in theory, I completely get that as well. But like you said, if it opens the currency out to further, regulation, if it's less decentralized, as I think you said, then yeah, it'd be interesting to see how much impact that has. What is more important to investors? Is it the green credentials, or is it the fact that it is a decentralized currency? But no, really interesting. I just want to say a few quick hellos to some people who are joining us actually online from around the world. I noticed we had somebody joining us from Sydney. So hi, thanks for joining us from there. We've got Louise joining us from a grey Farnham in Surrey. Well, sorry about that, Louise. We can't do anything about the weather, I'm afraid. And we also have people joining us today from India. Oh, we have Mohammed joining us from Dubai. Hi, Mohammed. He can play a mean game of golf, I must say. Hanif joining from Malaysia. Thank you for joining us. And any more? Oh, yes, there we go. More hellos. So anyway, hello, wherever you are joining us from around the world. We really appreciate you taking the time for joining us, and also for getting insights into fintech and insurtech. Talking of which, Alex, you've been very quiet so far. So why don't you share some of that superior knowledge that you've got tucked away in that brain and tell us a little bit of fintech news?
I thought you'd never ask. Yeah, so the insurtech story this week is about US-based Pi Insurance. So they've closed one of the biggest funding rounds within insurtech so far this year. So it's raised $315 million in Series D from the likes of Centerbridge Partners and Allianz X, along with a few other returning investors. Now, Pi is one of a growing number of insurtechs and fintechs that are targeting the smaller end of the business spectrum. So SMEs obviously face considerably different challenges to larger organizations. And in particular, Pi deals with workers' compensation insurance. So that's insuring your business against the effect of one of your workers becoming injured on the job, paying for their medical expenses, their lost wages, and so on. Now, according to a survey from Insurion, over a quarter of small businesses in the US don't have workers' comp insurance, and 30% of business owners are actually unsure about whether or not they needed it. Now, most states in the US require businesses to have workers' comp insurance if they have employees. Texas, I think, is the only notable exception to that. So, of course, the consequences for small businesses if they don't have workers' comp insurance can be catastrophic. Business owners can be fined thousands of dollars for flouting the state mandates. And even if your business isn't required to have workers' comp insurance for whatever reason, the potential cost of settling if one of your employees does get injured at work, well, it can be more expensive than small businesses can afford right now, particularly given that the price of most things seems to be going up anyway. So Pi Insurance is there in that sector, making it easier for small businesses to access workers' comp insurance. It's doubled its gross written premiums in the last year alone, and now the InsurTech wants to expand into new lines of business and develop its proprietary pricing algorithms using the money it's raised. CEO John Swigert calls the $315 million funding round monumental, and Pi itself claims that it's the single largest capital raise this year for a US-based P&C insurer. In fact, we make it the third largest of the year globally, behind WeFox's $400 million Series D round and Acrashaw's $725 million private equity round.
Okay, and this is all obviously showing movement in the right direction, I'm guessing, right? With these funding rounds, like you say, there's some significant investment happening here, and as you rightly said, the prices are going up everywhere. Obviously, inflation rates are soaring, interest rates are going up, and businesses, no matter what kind of industry they work in, are facing risk everywhere that they look, which is probably a good environment to be in insurance, right?
Yeah, I think it's a mean feat as well to raise over $300 million given the current circumstances.
Absolutely. Okay, well, look, we will talk some more about InsurTech after the break. And also after the break, we're going to be looking ahead to FinTech Live, which, as I'm sure you all know, is taking place on the 1st and 2nd of November in London as a hybrid event. And we're also going to be looking at 5 alternative investments for these turbulent times. So that might give you some advice on where to spend your hard-earned money. So don't go away. We'll be right back in around 90 seconds. See you after the break.
So the spirit of Vodafone is really to be customer-centric and having the ambition to create the future. I'm Varun Krishnan, and I'm the Managing Director for the Payments and Insurance business at Vodafone Group. So we have 3 core lines of business at FinTech at Vodafone. We've got our global carrier billing platform, where we enable consumption of digital content and apps for our customers on our Vodafone bill. Secondly, we have an insurance business, which today is largely focused on smartphone insurance. And finally, we've just been working on and launching our device lifecycle services business, which covers our customers' needs around device trade-in and financing. So as Vodafone is relatively new to this space, we rely a lot on partners to give us the depth of knowledge and access to technology to build these compelling propositions for our customers. So the future of our payments and insurance business at Vodafone is really about transforming our device insurance business from smartphone insurance to multi-category insurance, evolving our payments platform to adapt to subscription-based models, and finally, to really scale our device lifecycle services business to support our planet and sustainability ambitions.
Okay, welcome back, everyone. And still to come, we've got the results of our poll. I know for a fact that more than 420 of you, I think, have voted. So thank you so much for taking part in that. Just a few more quick shout outs to people joining us around the world. We have Bernard joining us from Munich. We have Ramiz joining us from Dubai, and have Nazish Ali joining us as well. I'm not sure where you're tuning in from, Nazish. Maybe you can just drop us a line and just let us know. But thank you all for joining us and for taking part. But back to the show, and first, Joe, I think we've got another interview. You've been busy, haven't you? You've been busy doing all these interviews. Who else have you been speaking to?
Lots of interviews on crypto. There's so much going on in crypto at the moment. So I spoke to Rodrigo Massano, a business intelligence lead, and Prasanth Balasubramanian, who is founder and CTO of Striga. So Striga is an Estonian-based fintech that enables companies to launch business, banking, payment applications that are powered by crypto. And they recently partnered with Zeeves to create a crypto-friendly neobanking platform, which is called Zeeves Neo. And you can see the full interview shortly on the FinTech website, but for now, just here's a short excerpt.
I mean, what regulations will a crypto bank need to follow? Because obviously there's so much discussion about DeFi and regulatory practices and whether, you know, there will be some overstepping there, whether it will ruin the DeFi space if there's too much of it. What would a bank need to take into consideration, and what would be acceptable?
Well, that's a hard question to answer. I guess there's various ways to look at it, and there's many components to it. But in a nutshell, any sort of crypto service that anyone wants to provide, it really boils down to two components of custodying funds and the exchange of funds into fiat currency. So the hardest thing to do is when you're custodying a user's assets, one is how do you ensure that money that comes into your system is legitimate or like it hasn't been used for illegal purposes. And the second one is when you're exchanging it into fiat currency, how do you ensure that you're not like implicitly enabling money laundering of some sort? And the answers to these questions are really, really hard to tackle. And in the traditional banking system, banks have come up with quite sophisticated methods to handle these sort of transactions with fiat currency. And then this needs to be replicated in the crypto world today. So especially in the European landscape now, regulations have come to a point where it is, I mean, it's quite strict. It's at the borderline of getting over-regulated, where it could, for example, destroy, like at least in Estonia, like one of the more recent things we've seen is they've sort of wiped out the possibility for a startup who's just raised even if you raise $100,000 in seed funding, there's no way you can operate a crypto company in Estonia, right? So that definitely does kill some level of innovation in Estonia, but then the ones that are able to comply and stay can provide services to the smaller companies, just like how the larger banking companies are able to provide services to small startups today. So it does breed a new industry, but at the same time, it does have a negative effect on like smaller companies.
Okay. And Rodrigo, as the kind of business intelligence arm of Striga, what's it like trying to put together a strategy on a project like this?
Well, it's a lot of research, a lot of exploring, given both how new this entire environment is and how restrictive many of the conventional channels are towards anything related to crypto. For example, Google has many policies blocking crypto information. It's being a very exploratory experience. So we have to basically go through very case-by-case studies, go analyze every single company, every single license to see which companies comply. And after we get a picture of who we're dealing with, we can only start actually analyzing and going out to them. For the most part, it's like discovering a whole new continent in terms of businesses. It's very challenging, but at the same time, very exciting. You get to know projects that are not usually out there.
Okay, another really interesting looking interview there, Joe. And as you said, a really nice plug for the website, by the way, Joe, before we went to there. You can see, obviously, the full interviews, and you can see all of the stories that we've been talking about on our websites. And if Kieran is listening, there he is. Kieran's not sleeping. He's an avid viewer of the show. FinTechMagazine.com and InsurTechDigital.com. Now, that's where you will find all of our daily news content. You'll find our digital publications that we're talking about and about to talk about, and all of our video content as well. So make sure you read those websites, and obviously you can subscribe to our newsletters as well. But Alex, coming back to you, because again, we haven't heard enough from you today, as far as I'm concerned. What are your thoughts on crypto and mainstream currencies becoming more entwined and interchangeable?
Yeah, I mean, that was a really good interview. I might catch up on that later, but I think certainly there's very little doubt about whether cryptocurrencies are going to become mainstream. They're going to. It's just about when and how. And I suppose at the moment they sort of resemble foreign currencies. You know, you can convert between fiat and DeFi and vice versa. But you wouldn't necessarily expect to go to your local supermarket and be able to pay directly at the checkout in I don't know, Colombian pesos or Croatian kuna. I think that moment of mainstreaming, the moment where we can say that cryptocurrencies have definitely become interchangeable with physical money, I don't think it's going to happen when we say it happens. I think it will happen when ordinary consumers start to see the benefits in their everyday transactions. You know, and that doesn't have to be in store. You know, it can happen entirely in a digital sense. But I certainly think consumers have to notice it happening. I think it depends on how we increase that level of visibility in people's working lives.
Okay, I'm going to put you on the spot here, both of you, actually. Then, so Alex, first, when do you see this tipping point, this magical point that you just talked about there? Do you think that's going to happen in the next year, 5 years, 10 years?
I think it could be a very slow road. I think it's not going to be up until the point where consumers who aren't particularly well versed in financial issues know, first of all, what crypto and blockchain are, which I think is still a minority thing. And I think it's not going to happen until they can see sort of benefits and features in their everyday financial lives that they can then attribute. They then look at those and they know that's because of the blockchain, that's because of cryptocurrency that I'm able to carry out that transaction. So I think it could be quite a slow road.
Joe, what do you think?
Yeah, I agree with Alex on that. I mean, if you just look at the way the most popular payments are made these days, I mean, they're still being made via card. So many people still don't even use their mobile phones in terms of making payments. So we're still sort of very much behind the curve in terms of catching up with crypto being a mainstream payment vehicle. Could be, I think, possibly in about 5 years' time, we might start to see a change. But I think it is going to be a very slow transition.
Okay. Yeah, I think I tend to agree with both of you there. You know, unless we see some kind of world event, whatever that might be, that somehow accelerates the take up or the amplifies the benefits, then I think we're in it for the long haul, and probably quite rightly so as well. Okay, so it's September. Well, it's almost the end of September. So we've actually got 2 magazines out this month, as I'm sure you know. Loads of great interviews in there and features in both InsurTech and FinTech magazines. So as I said before, make sure you go and visit the websites and you can read them all there. But obviously we've got both of our editors here. So Alex, why don't you give us a pick from both magazines, and why don't you pick one first from FinTech? What's your highlight?
Yeah, so as you say, since our last live show, we've got 2 new magazines out. So FinTech September issue is out now, and in this month's magazine are rather striking cover features about blockchain. So among others, we spoke to OKCoin about the level of confidence that there is within blockchain right now, particularly, you know, given the damaging devaluation of a lot of cryptocurrencies, and how much of blockchain's future relies on informing and educating normal consumers about the advantages of blockchain technology, you know, something we were just talking about. We've also profiled Nikolai Storonsky, who is the adventure-seeking CEO and founder of Revolut, who's amassed a personal fortune of around $7 billion. Now, he was a keen athlete and championship swimmer during his youth, surprisingly, but that's probably helped instill in him a sort of fierce work ethic and determination to succeed. But there have been times in business where those values have put him at odds with Revolut's own employees. And then we also have important features covering the transition towards net zero within FinTech, the future of community banks in a global economy, and we also take a look at how the global economic downturn is affecting so-called decacorns, those unicorns that have reached a valuation of at least $10 billion.
Absolutely. And obviously, you know, InsurTech as well. So what's one of your highlights from InsurTech magazine?
Of course. So in InsurTech this month, our cover star is Sten Saar. And I thought I was going to get that wrong. It's a bit of a tongue twister. He's the founder of InsurTech Zego. And he's gone from selling notepads to students at university to building a $1 billion InsurTech. So we go into detail about his astronomic rise within the insurance industry and how he came up with the idea for Zego while working for Deliveroo. We also look at connected devices within the home, things like smart speakers, smart bulbs, smart detectors. How much of an opportunity do they present for insurers to receive more data, reduce exposure, and then lower insurance premiums for their customers? And what price for the insureds? How much data are people willing to give up, and what do they expect in return? We also examine how prepared insurers are themselves for cyber risk. We ask whether legacy insurers are doing enough towards digital transformation, and we'll also count down the top 10 digital insurance leaders in the US. All of that and more in the September issue of InsurTech Magazine.
All of that and more in the September issue. I love that. I love that little payoff. Okay, right. Well, I think it's probably about time for the LinkedIn poll. Joe, do you have the results?
I do have the results. So our question, just remind you of that again, are real estate investments in the metaverse a good idea? And 19% of you voted yes. 31% of you said it was still a risky business, and 50% of you said it was a foolish pursuit. But we've actually got some comments as well that have I'd like to read out because they do mirror exactly what's come out on the poll. So from Lizelle Pratt, who is the COO and founder of Capital X, she says, "I'd prefer to buy real estate in real life where I can physically touch it." And Pierre Gaudet, he is the CEO of Philanthropit. He says, "Metaverse, no. Tokenized compliance securities, yes." And then finally, we've got Arzo, who says, "Real estate in the metaverse is Roblox for adults. Just throw your dollars away." So I think they're all quite nice statements, really.
Oh, well, I thought we were going to have a balanced view there. I mean, I know there's 50%
No balanced view.
It would have been nice for someone to come on and share their views as to why it's a brilliant idea. I don't know if any of our viewers are watching now. We've still got a couple of minutes left, but if you have strong feelings about the results of that poll, and if you think everybody should be investing in the metaverse, well, one, you're probably not going to say so, are you? Because that's just going to put the prices up. So you're smarter than we think by keeping quiet. I've talked myself out of asking the question of the audience there. But if you want to speak out in defense of real estate in the metaverse, then please do leave us a comment right now, and we'll try and get back to you before the end of the show. I mean, but the good thing about the metaverse is, who wouldn't want to live next door to Snoop Dogg, right? And that gives everybody the chance to do so. Normally, it's Friday, it's the afternoon, it's the end of the week. Might already be the end of your week, depending on where you are. And normally we have the end of the show to bring things to its inevitable climax. But today we're going to have a slightly different take, and we're going to take a look at some alternative investments. The usual market's a little bit flat, and it's always good to see what else is out there for people looking to spend their hard-earned money and who aren't convinced about the benefits of the metaverse. So, Joe, why don't you tell us a little bit about that? What are the 5 alternative investments, and what do you think about them?
Okay, yeah, so we've got some graphics for you demonstrating our favorite ones right now. And I do hasten to add at this point that this is our own opinion, and it is not a cue for you to place your life savings into the following areas, okay? So we're not professional investors, we're simply reporting on what's interesting and what's out there in today's slightly crazy marketplace. So kicking off at number 5 of the 5 alternative investment suggestions for turbulent times is the hemp-derived CBD market. So in the US alone today, this market is worth 1.3 billion. But that has risen from 390 million in 2018. So we've seen skyrocketing growth in that area. And of course, we're not suggesting that you partake of any illegal activities, but the cannabis industry in the US is now an absolutely legitimate concern, and it is highly profitable. You can invest in marijuana stocks or exchange traded shares, which are entirely above board and a very long way from any kind of murky industry connotations. So that's an interesting one to look into if you've got a little bit of money in a biscuit tin under the bed. So moving on to number 4, our 4th favourite As comic books. So comic books can be massively profitable, and can literally make you a fortune. So an example of this would be a 1938 comic featuring Superman for the first time, and it sold for over 2.1 million at auction in 2011. So if it were on the market today, that price would be considerably higher. Now, this particular comic belonged to Nicolas Cage, and he sold it to get himself out of a financial hole following a spending spree binge on luxury cars and exotic animals. So comic books are a great investment. However, a word of warning, rather like fine art, you do need to know exactly what you're dealing with, because there are a lot of cheap repros out there, and it does require an expert eye and initially some heavy investment.
Can I just say, Joe, I think Nick Cage was actually just diversifying his portfolio by investing in classic cars, not splurging on classic cars. So, Nick, I'm right with you, but good to obviously have a diverse portfolio. Not that we're giving any financial advice, of course. Okay, Joe, what's next?
Absolutely. Okay, so number 3 is toys. Okay, now some lines of toys offer huge investment returns. So, for example, certain Lego sets and limited edition Monopoly boards can command big bucks. Now, the slide we have here, it's not the best picture. I did try and find a clearer one. It's actually a 1990s toy line of the Beanie Babies. By Ty, and this is Nana the Monkey. Now, Nana the Monkey recently sold for $4,000 on eBay. So that just goes to show, you know, sort of like a little toy that maybe up in a dusty box in your attic, and you know, you could make some serious money from it. Alternatively, if you've got $4,000 to splurge on something, Nana the Monkey could be your choice. So, the other thing that's actually really good is our Lego figures. So there's a 2013 Spider-Man Comic-Con figure that's currently being valued at $9,449. So, you know, if your kids were growing up in the early 2000s and they were huge Lego aficionados and they've left home now and all their stuff is up in the loft, why don't you go and have a look? It could become a really profitable thing. So number 2, if we move swiftly onwards, is wine. Another nice one to be going on with. So according to Forbes, wine is a tangible asset with a track record of reliable returns and low market correlation, and it offers a degree of stability during market turbulence. There you go, you have it from Forbes. So wine and whiskey and champagne have all exhibited unprecedented investment value growth over the past 5 years. They're also tax efficient, and the buyback potential is really strong with these ones. So you're unlikely to lose your money unless you've got teenagers and they accidentally drink it. So again, one to be careful with, but definitely a fun one to invest in. And number 1 is of course real estate. Now, it's not exactly an alternative investment, but if we're thinking about sort of stocks and shares, it is slightly sort of out of the way of that. But for the past 30 years, the real estate market has actually outperformed the stock market. And now there are just so many options that you can delve into if you don't have huge amounts of money to, say, invest in a buy-to-let property or even buy a field somewhere. So there are crowdfunding platforms that can enable you to pool your money. So you could, say, invest in a small percentage of a multi-family housing property, such as an apartment building. There are other options like parking spaces that you can buy in strategic areas that have huge return on investment. And I think it's just a really interesting market to explore. And I think one of the things I would say is when you're considering investing, always look at what the rich fellows are doing, because they have the resources to do the research and have the predictive analytics, and they really have a much clearer idea than the rest of us small minions have. So, for example, with real estate, Bill Gates has over the past 2 years, we all know, purchased 269,000 acres of farmland. Well, if Bill Gates is doing it, we all know that it's going to have a profitable return. And so while we might not be able to put down that much, we could essentially look at much smaller investors. And I suppose that's another lesson, actually, going back to the poll when we talk about investment real estate in the metaverse. If you notice, there are a lot of very big companies and banks that are investing in that space. And so even though it's in its nascent stages, it's very embryonic, I think that there could also be some positive returns for that, but it's not on our list today. So,
Okay.
That's our list. So do you guys have any sort of favourites in there?
I'm going to let Alex go first, actually. Or Alex, maybe you have something else to add to this list.
I don't have something else to add, but I like the idea of wine as an investment. I like to say that I invest in wine once or twice a week, I think.
Absolutely. I think if you add to your collection on a regular basis, Alex, that's probably the best way of collecting wine. But yeah, it's interesting wine. I remember writing a feature about this a few years ago, actually, and it's quite incredible how wine has outperformed virtually all of our investments, actually. The other thing is something we sort of mentioned, which is the smartest cookie, Nick Cage, obviously investing in classic cars. There's a huge market there right now, and it doesn't have to be, your 1960s Porsche or Ferrari. It can be a early 90s BMW or, Volkswagen Golf or something. Anything that creates a certain degree of nostalgia with people who are now having disposable income. And quite often it's people who are harking back maybe to their first car or the first family car that they remember from their childhood. So there's a huge market there. The other thing that I would add in terms of tangible assets is art. And along those lines as well, I'm glad that we haven't got NFTs in this list. So that's all I'm going to say about NFTs. Right, we're going to move on because we're way over time. It's all those interviews you've been doing, Joe. I just want to quickly remind you about the FinTech Live event, which is returning, as you know, on the 1st and 2nd of November. And we've held these previously at Tobacco Dock, but for the next instalment, we're moving to a new venue called Magazine London, which is in Greenwich. Once again, this is a hybrid event, so you can join us in person. We'd love to see you there. Myself, Joe, and Alex will all be there to chat to all the executives who are there and talk to any attendees as well. And if you can't make it, then of course you can join us online. It's a hybrid event. And tickets are now available. So go to our website. If we can have those up on the screen, please. You should know them by now. It's FinTech Magazine and InsurTechDigital.com. Visit the website, go to the go to the events drop down, and you'll be able to find all the details for our live event. But as I said, we've run out of time pretty much. It's been a packed show, and always a pleasure to speak to Joe and to Alex. Thank you for their contributions, and of course to you for joining us from around the world. We really appreciate you, taking the time to join us and joining in with our poll and with our discussion as well. Thank you also to the video team and the marketing team. We've done another great job today. We'll be back in 2 weeks' time. Slightly different, actually. Slightly different date, slightly different time, slightly different format. We've got a special show for you. We'll be sharing more details of that on our social media channels. But don't miss it, and we'll see you again in almost 2 weeks. But until then, it's been fun. Have a great weekend. Whatever you invest in this weekend, do it wisely and be sensible. So, bye for now.